As autumn arrives, a familiar chill sweeps through global financial markets, reminding investors that this season often brings more than just falling leaves. The transition from summer's optimism to autumn's uncertainty is felt not only in the air, but also in the numbers flashing across trading screens worldwide. September's reputation for market downturns is hard to ignore. Year after year, investors brace themselves as the ninth month approaches, aware that history is not always on their side. For decades, the so-called September effect has haunted investors, with stock charts dipping into the red more often than not. The anxiety is palpable as portfolios are tested by seasonal headwinds that seem to return like clockwork. This isn't just superstition. Historical data from New York to Jakarta confirms September's tendency for weak or negative returns. The pattern is so consistent that it's become a topic of study for analysts and economists alike. Major indices like the Dow Jones and S&P 500, as well as Indonesia's Jakarta Composite Index, have consistently underperformed in this month. These declines aren't isolated incidents. They're part of a broader recurring trend. In 2025, both markets once again faced headwinds, reinforcing September's spooky reputation. Investors watched as familiar patterns played out, with volatility and uncertainty dominating headlines. The September slump is a global phenomenon, not just an American or Indonesian quirk. Markets from Europe to Asia have all felt the sting of this seasonal downturn, making it a truly worldwide event. Understanding this pattern helps investors prepare for volatility rather than panic. By studying past Septembers, they can develop strategies to weather the storm and even find opportunities amid the turbulence. It's not about predicting the future, but about recognizing cycles and sentiment that shape the market. Awareness of these trends can help investors make more informed decisions, even when the outlook seems grim. By exploring why September haunts stocks, we can better navigate the complex forces at play and perhaps turn seasonal fear into a source of insight and resilience for the months ahead. In Indonesia, September is notorious for market jitters. Every year, as the month approaches, investors brace themselves for heightened volatility and uncertainty. The period is often marked by increased caution, as both local and international players keep a close eye on the market's every move. The Jakarta Composite Index, or JCI, has ended September in the red 8 out of the last 10 years, with only 2 exceptions. This persistent trend has made September a month of concern for many market participants, who often anticipate turbulence and adjust their strategies accordingly. The COVID-19 pandemic in 2020 saw the JCI plunge over 7% in September, amplifying the month's negative trend. The pandemic's impact was felt not just in Indonesia, but across global markets, highlighting how interconnected and vulnerable the JCI can be to worldwide events. In 2025, the JCI opened September with a sharp 3.61% drop, setting a pessimistic tone for the month. This immediate decline sent shockwaves through the financial community, reinforcing the perception that September is a particularly risky time for Indonesian equities. Ongoing profit-taking and a weakening rupiah added to the pressure, pushing the index closer to key support levels. Investors became increasingly cautious, watching for signs of further declines and reassessing their positions in light of the currency's instability. This recurring pattern isn't just bad luck. It points to deeper local and global factors converging each September. Seasonal trends, fiscal policy changes, and global economic shifts all play a role in shaping the JCI's performance during this period. Investors and analysts look for clues in everything from domestic politics to U.S. policy decisions. They analyze economic data, monitor central bank announcements, and try to anticipate how international developments might ripple through Indonesian markets. Recognizing this cycle is crucial for navigating the challenges September brings to Indonesian markets. By understanding the historical patterns and the factors at play, investors can better prepare for the volatility and make more informed decisions. Understanding the JCI's September struggles is the first step to making smarter investment decisions. With careful analysis and a strategic approach, investors can turn September's challenges into opportunities for growth and resilience. The September effect is even more pronounced on Wall Street, where the world's most influential stock exchanges set the tone for global markets. Since 1950, the Dow Jones and S&P 500 have posted their weakest average returns in September, consistently underperforming compared to every other month of the year. This persistent trend has puzzled analysts and investors for decades, as September's negative returns stand out even in long-term data. The Nasdaq and Russell indices echo this trend, with average losses around 0.4% to 1% for the month. Even technology and small-cap stocks, which often behave differently from blue chips, are not immune to September's drag. Notable periods like 1999 to 2002 saw consecutive September declines during times of crisis. These years were marked by economic uncertainty, and September seemed to amplify the market's anxieties, leading to sharp sell-offs and heightened volatility. The U.S. market's size and influence mean its September slump often ripples across the globe, impacting markets like Indonesia. When Wall Street stumbles, international investors take notice, and the effects can be felt in both developed and emerging economies. When sentiment sours in New York, it spreads quickly, dragging down investor confidence worldwide. The interconnectedness of today's financial systems means that a bad month in the U.S. can trigger caution and sell-offs in markets thousands of miles away. The September effect isn't just an American problem, it's a global market reality. Investors everywhere brace for turbulence, knowing that history often repeats itself during this month. Understanding Wall Street's September history is key to grasping why stocks struggle everywhere this time of year. Analysts study past patterns to anticipate potential risks and prepare for the seasonal dip. The pattern is clear. September is a month to watch for volatility, uncertainty, and sudden market moves. For investors, it's a reminder to stay alert and be prepared for anything. Local events can turn a typical September dip into a full-blown downturn. In 2025, massive protests erupted in Jakarta, intensifying the JCI's woes. Markets hate uncertainty, and social unrest directly threatens economic stability. The JCI's sharp drop on September 1st coincided with escalating demonstrations, echoing similar market jitters during protests in 2019. Political instability and cabinet resignations only add to investor anxiety. Protests disrupt business, supply chains, and consumer activity, hurting company earnings. More importantly, they trigger capital flight as investors seek safer assets. Combined with the global September effect, these local factors create a perfect storm for volatility. The result, the JCI faces both a historical curse and immediate real-world risks. For investors, understanding these triggers is essential for managing risk. Why is September so tough for stocks? It's a mix of behavioral shifts, fiscal deadlines, and psychological turning points. After a quiet summer, traders return in September, often selling to lock in profits or reposition for year-end. This surge in activity can tip markets into the red. Many mutual funds close their fiscal year in September, prompting managers to sell losing stocks and realize gains, a practice called window dressing. This concentrated selling adds downward pressure. September also brings heightened anxiety about upcoming earnings and economic data. Concerns about growth, inflation, or global tensions feel more urgent as the year's end approaches. The result, markets become more sensitive to bad news, fueling the September effect. It's a perfect storm of timing, psychology, and institutional behavior. Human psychology is a major driver of the September effect. The end of summer brings a shift from relaxed optimism to cautious realism. Investors return from holidays, scrutinize their portfolios, and often decide to take profits or reduce risk. Financial media amplifies September's bad reputation, creating a self-fulfilling prophecy. Fear spreads quickly. When investors expect trouble, they're quicker to sell at the first sign of weakness. The anticipation of third-quarter earnings adds to the anxiety, with companies and analysts bracing for potential disappointments. This collective bracing for bad news leads to more selling and reinforces September's gloomy reputation. The cycle is hard to break. Negative sentiment feeds on itself. Understanding this psychological pattern helps investors avoid knee-jerk reactions. Awareness is the first step to breaking the cycle. Institutional investors, pension funds, mutual funds, hedge funds, move markets more than individuals. After a summer lull, these big players return in September, triggering a surge in trading volume. Any negative sentiment is quickly amplified when institutions start selling together. Portfolio rebalancing and profit-taking are common, especially as managers prepare for year-end performance reports. Large-scale asset rotation can create significant downward pressure. When thousands of funds sell at once, the market must absorb a wave of selling. This collective de-risking by the smart money is a powerful force behind the September effect. Understanding institutional behavior is key to anticipating market moves. Central banks, especially the U.S. Federal Reserve, play a crucial role in September's market mood. The Fed's September meeting often signals major policy shifts, like rate hikes or changes in asset purchases. Even hints of higher rates can spook markets, making bonds more attractive and stocks less appealing. In 2025, investors are watching inflation data closely, knowing the Fed's decisions could keep rates higher for longer. The Fed's actions ripple globally. When U.S. rates rise, the dollar strengthens, pressuring currencies like Indonesia's rupiah. This can fuel inflation and prompt international investors to pull money from emerging markets. The shadow of the Fed's September meeting looms over both Wall Street and Jakarta. For investors, central bank signals are a key risk factor each September. Staying alert to policy changes is essential for managing volatility. So, what should investors do? Don't panic. The September effect is a tendency, not a guarantee. Some years buck the trend. Trying to time the market perfectly is risky and often backfires. Instead, use September's history as a reminder to expect volatility and stick to your long-term plan. View market dips as potential buying opportunities for quality stocks. Buying the dip requires courage and conviction, but it's how many investors build wealth. Awareness of the September effect helps you manage emotions and avoid impulsive decisions. Diversify, check your risk, and be prepared for turbulence. Markets will always surprise, but knowing the history gives you an edge. In both Jakarta and on Wall Street, a little caution and a lot of perspective goes a long way.